Good morning. I am Scott Forcino from Real Brokerage LLC, based in New York City and Florida. I'm an associate broker. I form PlugIntro so real estate professionals have a way to reach their intended audience, to deliver their professional message, how they can help others, and why they're the best choice. We have Jason Ramirez today, a friend who's a long-term mortgage pro. He has a lot of insight as to the market and some innovative strategies to help the public qualify and help create relationships in this changing, really tough market. And today is what, October 2nd. So a lot's got on. So Jason, good morning. How are you? Tell me what you see, what you're experiencing, what you think we can do.
Good morning, Scott. Thanks for having me again. So the market, I think it's starting to, well, not that I think, I know it's starting to pick up. I'm starting to see a lot of activity. And this is just based on pre-approvals coming in and people making offers on properties. Now, I did say that, regardless of where rates are, rates seem to be stuck in this hybrid, this space. So you're gonna start seeing activity formulate around these rates. It's just the way it is. You just needed them to stop popping. You don't want to see 8%. We've been at this level on the interest rate already months ago. We came down and now we're back. So it seems to be the current range of rates. So you're going to see activity formulate around this. Now, what that does in terms of, or how that affects people looking to buy certain price points, that's obviously another situation altogether. You're going to have to readjust your price points on, certain house that you can buy, because if the rate is 100 basis points or rather just 1 point higher, then that could affect your buying power by XYZ dollars. And if you don't have the significant down payment, things like that, it could affect your buying power, period.
So are you experiencing the people who jump in at 3% and now they're saying, how am I going to leave 3% and jump into 7.5%? What do you say to them?
I think that's a short term, that's an immediate impact. I think that's just the secondary reaction to where rates are now, an unintended consequence, so to speak, to where rates are now. Your points for having to move or refi, it has to be a reason, right? So there are people that are refinancing. They are, because they're loaded in debt. They have a lot of stuff going on and they need to pull equity out of their property. But as far as an upgrade or a downgrade, people are just being more, I think they're going to be more open-minded to it. I'm starting to see people become more open-minded to it because this is the norm now. The people that don't want to leave the 3%, I get it. It is an unintended consequence of rates being this high right now, but it's an early, you're going to start hearing less and less of that because this is just the way it's going to be and people are going to accept it and they're going to move on. We're going to adjust to the current interest rate environment and we're going to move forward and activity will formulate. One of the things that's interesting right now is that 34% of all new home sales are first-time home buyers. 34%. That's a tremendous number. That we've never seen that before. 34% of first-time home buyers.
That's impressive. I wonder how they can, given these market conditions.
Because people, people could afford. They could. Look, you're not gonna buy that $1 million house, $1.2 million house. If your ratio was tight at 4%, maybe that's probably not the house for you. You may want to downgrade your price point. People are being more realistic about what they want. It's almost like a seller, that has an unrealistic view of what their house is worth. I mean, I'm sure you've came across it a million times. I've came across it. It's just the nature of the beast. You tell them your property's worth 800. Oh, but my friend sold it for 1.2 million. There you go. Unreasonable, right? So it's going to be the same thing with buyers. Their price points are going to have to become more reasonable to what the current interest rate environment is. It's just the way it is. Once upon a time, a $1.2 million property was, seen as somebody who was wealthy. And all of a sudden, the last 5 years, it almost became the norm to have a especially in the Northeast, rather, it almost became the norm. Like, oh, 1.25 million and you take it out a 900 mortgage. Like, these were just unrealistic levels,
Yeah. Plus, in your market, Long Island, with the high tax, it became, more rarefied air. It's really only these salaries in this kind of business environment.
Exactly.
But I had a buyer recently, and it occurred to me there's two kinds of buyers. There's the really, as you stated, really high incidence of first-time buyers, but then there's Mon Pa Kettle who bought in 1983, and then there's the other people who bought in 2019, and those people have equity. So how can you compare this free monopoly money, because you didn't go to work, you didn't save for it, you just went to bed. So now, if the payment is a lot more, you can't compare a guy who has assets, reserves, to pay another 400 or 500 a month than the people starting out with their savings. So sellers, have to be addressed. First question I've asked is, how long have you owned your home? Okay, 7 years or 17 years. Well, now you have plenty of money. So don't complain about 500. You're competing against people that don't have a house they just sold. What do you think of that strategy?
Well, they are. It's to what I said earlier. It's a knee-jerk reaction or statement, an unintended consequence. There it is again, of the market in terms the rate environment moving so fast that people haven't mentally caught up to it yet. That's really what it is. Once they've mentally caught up to where we are in the market, it will adjust. Your appetite will adjust. Where you want to go will adjust. All this will adjust. It'll open up new markets. We look at the Northeast, specifically New York and Connecticut and parts of Jersey. We look at that as the end, as everything, but it's not. There are other markets that are opening up. We look at, the Carolinas are big, Florida's tremendous, but those aren't the only places to move. I was in Nashville a couple of months back. By the way, that place is great. If you haven't been there,
sure, I have. Yeah, it's ridiculous.
It's fantastic. I love that place. But I was there.
It's great if you want to go out at night.
It's fantastic. But I see the real estate market over there. I'm like, okay, there's life here, and it's affordable. My son goes to Oswego, upstate, and I'm looking at the houses. There's a lot of beautiful homes up there, and you're just like, wow, it's not expensive. There is other places in this country, in this state no less, that are very affordable. And the fact that people work from home more now than ever, you could afford to buy something further away from your office location because you don't need to be there. Or
good point. That's the result of COVID. But there's also, people say, how's the market? There is no market. If you're in place if you're in Florida and you're taking a lot of New York, suburban, or Manhattan, the island money, there are a lot of places that are cash. So the people if you have the money and you want to relocate, let's say for warmer weather or for no state income tax, you're buying cash, and that's a micro market. Now buyers with loans are having a hard time competing with cash buyers. So that's a bubble. There are many bubbles in wealthier, urban areas.
Cash is king. Cash has always reigned. It didn't matter what market it is. If your offer was close, if you came in with a mortgage and you needed max financing and your offer was slightly more than this cash buyer, some more times than not, they'll take the cash buyer. One, they don't need to wait. They can close instantly. People want their money. Cash is king. Cash always wins, and it always.
Yeah, and there was another layer to that, which I thought realtors did a terrible job of. Let's say Jason is getting me a loan, and I say, great, Jason's a professional. You got perfect credit. But you got to sell something. So there's an entity outside our deal. It's a domino, as you know, effect, where how are we going to get into this deal with my client, the buyer, and Sophie's client, the seller, and Jason doing the loan? You guys, all of them, and I don't know what's going on with the buyer of my client's house in the sale. So there's so much riding on another entity. You don't know if they're clowns or they're serious or how solid they're. Am I correct in saying nobody gets into that even one step of the domino effect? It doesn't happen.
It's super tough when you have closing on a deal is contingent on the sale of another. I've experienced that 100 times in my career. I experienced it a few times this past month. You know, there's not a lot. It's just the nature of business. You know, it's very tough to navigate. The person that's really stressed out about this whole thing is the buyer, like our buyer. You know, because he or she they have to sell. They have two different closings, two different sets of issues, and then you don't know the person that you're selling your house to. They need a mortgage, so it's just a big trickle down. So it can become a sensitive situation. It's just where we are now. You know, we've
And
always
it's
been
also,
here, you know?
it got, I would say in the 12 or 15, whatever, maybe 10 years ago, the New York legal contract between the lawyers got wise to it and said, this is a tough one, in the mortgage contingency clause, they said if you need to get a loan and that is contingent on selling your house, that's considered firm. So the truth may not coincide with the party's rights and obligations. If you got someone a loan and they're, great credit, 850, everything perfect, great, 20 LTV, but then they need to sell inside our New York-based transaction, that's a firm commitment. But they really do need to. So you have potential legal obstacles that are specifically on point with the terms of the contract, but they're not responsive to real life.
I mean, there's so many moving parts, especially New York. There's so many moving parts. I try not to dive into the legality of it just because I have I have enough on my plate trying to, with other things. So I don't dive into the legality of it. You know, and New York's an attorney state, and
and I'm just relating my experience. So what can be done? I mean, I think there's an opportunity for lenders to create greater bonds with realtors those lenders that can provide some innovative strategies. They're not just sitting idly by. They could really, really assist and almost, I would say, more so than guide. They can really influence the way a transaction's done. I think sellers cannot wait for somebody to loan. They have to, on their side, take an approach or a method that makes their house more noticeable and more affordable. How's that done?
I mean, creative financing is how all this is done. Creative financing gets a little tough when there's so many guardrails with lender guidelines. Right now, I'm at TD Bank. Prior to that, I was a Citizens. Prior to that, I was a Wells Fargo. There's so many guardrails. Because people are afraid of another 2008 happening again, where they just lent to anybody with a pulse and a breath. So it's very tough to get creative. There are ways to do it, but lenders have to ease up. They have to ease up on the guidelines a little in order to really get creative, because a lot of times not everybody fits in the box. Or if they've created something, meaning lenders that are looking for market share, if they have created something that's creative for customers to get mortgages, they've created parameters that are very tight and they're not bending. So a lot of times you can be on the other side of that line, and it is what it is. You're not getting the mortgage. So to your lenders have to really ease up on guidelines in order for stuff to get more creative.
I agree with you, and but the problem is that's still coming from the buyer side, which means they have to work on their own, and they sometimes even need to convey the telephone game to the realtor, to the seller. I think, and tell me your opinion because you're the expert, that a lot could be done from the seller side. And of course, the buyer is going to be interested in a lower payment, whether it's temporary or permanent. And of course, they're going to enjoy the benefit of a rate that is something they could not otherwise achieve. So instead of instead of the buyer going right, I think the seller can go left and make their house on their own. They can push money across the table, closing costs, offer sales concession. I mean, tell us, because I'm not totally proficient as you are, what are some seller strategies and what can realtors do to make their client's house stand out?
Well, number one, price it reasonably. That's number one. You know, that's, I can't begin to tell you how important that is. And it does tend to get overlooked at times, you know, so it's unfortunate, you know, where they're asking for something that's, you know, sellers concessions are super helpful, especially in New York, because closing costs are through the roof in New York. You know, it can be extremely helpful. And because property values, you know, one of the things with a seller's concession is the property has to appraise for that number. So if you're buying a house
So how would
for,
a contract look? Tell us mechanically, if a house is 500,000 and the seller side wants to make it more affordable and more attractive, how does that work? How can you assist a realtor in making that their de facto approach?
well, you could do a contribution. Okay, a seller can do a contribution where they're giving money towards closing costs. That's the biggest one. There really is no, that's the knockout blow right there. That's the one that people want. That's the coup de grace right there. If you can get a seller to contribute to the closing cost, there it is right there. You know, because then that buyer has options. They can take whatever the money they're getting and lower the rate. You know, they can do a lot of things. So a seller's contribution is everything. Seller's concessions work differently because you're not really this, you know, nobody's really, the only person that's really winning there is the buyer. You know, the seller is just selling their house for a higher number because it appraised for that amount, you know, and they're building the closing cost in. So that's kind of different. But a contribution is it. That's it. You want to help as a seller drive the market, say we're applying XYZ towards closing costs, because people see how much closing costs are. That is, you know, besides interest rates, you know, interest rates not the only thing that scares people. It's closing costs. I know because I have conversations with people, and when they see these things, you see them lose, you know, they gasp as soon as they see it. I've seen it for, you know, 19 years. That's it. So if you could ease the burden on that, then perhaps the rate, you know, won't be as much of a hit, and they can take that contribution of some funds and buy down the rate. That's how.
No, of course I'm with you. Of course I'm with you, and I want to hear what, let's say, if instead of a 5% price reduction, what that could do. But you're mentioning some type of sticker shock, and I've always thought it's unfair to banks because you're the ones who initially let people know about closing costs. Lawyers do it last. Like, here's the news, here's your blood test. But I think always said it's unfair that lenders have to talk about things that don't involve them, like mortgage tax, like recording fees, like title insurance premiums. I've had clients say, "Why am I paying the bank's premium? Like, that's what it is." And why no one knows about mortgage tax. I mean, realtors don't know. They don't know until they're in the thick of it with you. So there are some huge costs which are actually unique to New York. So, I mean, I always thought it was unfair that you give this bad news as though you're the bad guy. Meanwhile, the city and the state and the county are the ones who collect the most money.
I mean, I've encountered that. You know, it is unfair for the bank to do it. But again, you know, if a customer's coming to me for a mortgage, you know, it's obviously the largest transaction they're doing or have ever done in their life at that given time, or definitely at least the top two, if not the biggest transaction they've ever done in their life. So they need to have their hand held and guided through the whole process. So I get that. I'm totally okay with telling people what the closing costs are, you know, as long as you properly educate them on how it works, the breakdown. I don't have those because when I speak to a customer, they're ready. It's almost like I'm teacher, grab a pen, we're going to talk this through. And a lot of times, you know, they'll see what I send them and they'll say, but, you know, this bank is offering less. I'm like, well, again, let's recoup, let's rehash what we just talked about. You know, it's just, you know, banks have, we have pricing engines and loan estimators. That's all we do. It's just an estimation of cost. Everybody has one based on the zip code. You can Google. I've said this a million times and I'll say it again. You can Google your closing cost. It's public knowledge. It's not a secret. The only thing that differs from lender to lender are bank costs and then rate. Everything else is all universal. So as long as that message is properly given to the customer, And, you may have to say it 5, 6, 7 times. It's almost like you're talking to a kid or a teenager. They don't get it the first time you say it. I have to say it 5, 6, 7 times until they have the aha moment. Oh, aha. Sooner or later, they'll have the aha moment. And then like, okay, so now if you really want these costs, talk to your attorney, let them get title, and they'll, that's how we do it. They don't always get it at first. I get it.
Yeah, that makes sense. I mean, it's also an uncomfortable situation because there's money involved, there's anxiety involved, and there's definitely money that they didn't contemplate. I've had people say, no, try it my way. I said, your way. The bank and the title company have their way. You can't control. Plus, there's other things that are really outside our control, where let's say it's middle of summer and the seller decides to put 2,000 gallons of oil in the tank. I mean, what? And then I've seen $3,000 bills that nobody thought of, and it's really not cool. But there's no reason why they can't either without our knowledge.
The one that gets people a lot, that's unfortunate, is the open taxes. Because depending upon what time of year you close, is going to determine the escrow number, which is, I break down closing costs into 4 sections. Section number 3 would be escrows, and that's usually the one that I feel catches people off guard, because within escrows you have open taxes. So if I'm estimating X, Y, and Z, but look, there's open taxes that are due, November 1st, let's say, because you're closing today, but there, anything owed in 60 days usually has to be picked up in the closing.
Right, and that's a good point. No one thinks, right, so you're escrowing for 6 months and you owe the next payment, which
so I mean, that's usually the blow to the ribs that people, they're like, whoa, I didn't expect that. And Long Island, it's not like taxes are $5,000 a year. Taxes can be 15, 20 G's. So if you're paying, a semi-annual payment, that could be $6,000, $7,000, $8,000, $9,000 right there that you didn't even account for. That's why.
And you can't, because, I mean, I guess the best job a lender or a lawyer can do, less so an agent, is say, okay, here's the time of year, and we're going to close October, and municipal records show the tax is due in November. Be prepared. So there's no way out. Plus insurance. People come with an insurance paid, and they say, wait a minute, why am I escrowing for a year and I just paid? It's 2 years of closing.
Well, you're basically, you're escrowing for the next year. That's basically how it works. So, I mean, I tell that to people. I just paid for the year. I go, I know that, but you're escrowing for the payment after this. So you're funding that account, and then when that payment is due, they'll pull it out because there'll be enough money in the escrow account. That's, they usually, oh, I get it. At that point, it's just people looking at they're looking at the finances, and they're just looking for everything that doesn't seem right. And I get it, because, when you see these loan estimates and these CDs, loan estimate in the beginning, the CD at the end, closing disclosure, I mean, it can be overwhelming. And when you see all those numbers, you're just like, you gas.
Right. And I tell you what, I've heard, and I've taken that approach, of course. You want your holidays there. You want your birthdays and graduations and a beautiful home. However, I don't think people can have it both ways. You're in business now. You're in business where your taxes up to a certain point are tax deductible. Your mortgage interest tax deductible. When you sell, the government gives you, if you're married, $500,000 of tax-free income. So it can't just be, oh, we're getting bombarded for our new home. No. You just went into business. You are here. There's a profit either available. Actually, there's always a profit available, because your interest deduction is shielding income. So, I mean, this is not just a pillow. This is a money machine. And if you get equity, that's even better. But if you never get equity, compare the payment versus rental. There's no money there. There's money here. So I tell people, you're in business. Even if you've never been in business, congratulations, you have a company.
Yeah, that's putting it lightly. It's just, as a loan officer, I try, to not be just a transactional person. You know, I try to guide them through the process and talk them through it. It's almost like financial therapy to some degree, where you're kind of talking them through the process and getting them ready, teeing them up, you know, and if done properly, it can be a good, you know, even if something negative happens, at least they were aware that something negative was going to happen, you know, and you can truly take pride in that, you know, and that's how you wind up getting referrals and this, that, and the other, because, you know, I've heard loan officers over the years, you know, it amazes me how they operate. You know, everything's just like, I don't know what the rate's going to be. And like, or, you know, it's almost like they just want the transaction and they just want to move on. And like, you know, you kind of have to consult these people, especially if the biggest part of the business right now, 34%, is first-time home buyers. You got to imagine they don't have a lot of experience, and anything they're hearing is from their friend that just did a transaction last year from Google, or, you know, that's really where they're getting their information from.
Or their parent who hasn't done anything in decades.
Oh, yeah, or their parent who bought 30 years ago and said, oh, well, you know, it wasn't like this when I bought it. Okay.
Or the guy in 2021 who said, wait a minute, I never heard of any seller paying anything for anybody. What, are you kidding me?
Yeah.
So there's that. But, you know, I'm glad you mentioned that element of working with people and building a relationship, because I've maintained for the last while now, since COVID especially, that trust is under attack. There is every lender, probably even your own, and every insurance company has apps where the younger people, they think that, and I'm being general, they think that a direct conversation that we're having may not even appreciate my gestures. It's a confrontation. They're risk averse and they don't want to engage. So it's easy to do everything they do else is on an app. Amazon, Google, Facebook, all the social media. They live on their phone. So when we're gone, I don't think the 27 and the 33-year-olds are building relations, because the general age of realtors and mortgage pros is in the 40s and 50s. So this time is now, because these service providers are looking for consumer business. And it seems like the most important thing, the trust, the relationship, I know I could call Jason on Saturday morning at 8 a.m. He may not love it, but if we have a favorable relation and he's at his son's soccer game, he might say, yeah, I can't call you later. But we don't expect miracles, but we do love and enjoy the benefit of communication. So I think that we have to do everything now to provide others a benefit, where you have to stand out by being more than a mortgage professional. You have to be the guy that can be counted on and will be in someone's corner. I mean, so much trust to buy or sell. You don't do this maybe every decade or maybe every several decades. So I love what you're doing, and that's the only way to do it, I think, now.
You have to preach it. You have to be firm, resolute. You have to preach it. You know, some people, I have countless text messages of people that just want to do an entire transaction through text message. And every time I'll often say, give me a call, let's chat. And they'll send me another, and I'll answer, and I'll say, give me a call, let's chat. I'll always end it with, hey, give me a call, let's talk. And eventually, after 2 or 3 times, they ping me, they'll call me. And they're like, oh, this is so much better. And that's that's even a young millennial that's like that, I keep preaching it. Give me a call, let's chat, let's do this in 5 minutes rather than 5 hours.
You're showing your age. Yeah, they everything. There's no retail done. Everything's through the phone, and yes, it streamlines. And keep in mind, half the country is cold half the year, so you may not want to venture out, unless you're having some real fun. So we really are experiencing a change in the way business is done. We all know that. I had an insurance claim. I'm trying to call, and they're throwing apps at me. And on another insurance claim I had, they said, take pictures of the car, press the button. I pressed the button, and they sent me money electronically. No one came and saw the car. They just looked at pictures.
I gotta admit, that's a pretty good way to do it. Because if you can take a picture, the adjuster just goes there and takes a picture anyway. It's not like they're having a complication with you, right? So So I'm okay with that. I've experienced that before where somebody clipped my rearview mirror and I had to take a picture and all that stuff. So yeah, I get all that. But something like a mortgage purchase, taking out a mortgage, buying a house, redesigning a kitchen, uh, doing anything that has a lot of twists and turns and moving parts, you gotta do it verbally. I'll close it out with a text message to confirm or just to reiterate, but you gotta. There has to be some interpersonal connection. People
Right. Well,
wanna
you're talking.
they wanna
It's
they
not
wanna
just
work with
about
people
money,
that they understand. That they get.
right?
You know.
And the referrals are always who you know, like, and trust. And this is not purely about money. This is about preferences. This is about nuance. This is about nervousness. I tell you what, I saw an amazing statistic with regard to agents, and that is that under 1% in 2021, 2022, or of home buyers and sellers picked an agent from social media or an online source. And that surprised me a bit. You would have thought 10, 20%. But what really surprised was it was still people in their 20s, 30s, and 40s. So I think that they may love the electronic world how, to escape or to share, but when it comes down to putting tens of thousands down or owing hundreds of thousands, they still go to Uncle Bill or Mom or Dad. They still kind of did something out of the ordinary and looked at someone older, which shocked me.
Well, we could thank the scammers for that, right? Because
Oh,
there are, you know, how many times do you get a text message saying something odd, or I get an email saying something odd, or I won this, or click on this? Like, there's just so many scams out there, right? And to some degree, people will just brush it off as a scam. But as soon as it has to do with your own pocket, you're ultra sure. Because one thing I've always learned is you cannot mess with somebody's money. People act very, very weird when it comes to their money. So they want surety. They want to look at you in the eye. They want to hear you. They want to know you. They want to make sure you're not just some AI out there, which, by the way, is pretty amazing. But they want to make sure you're not just some AI out there. And when it comes to money, that's why what we do will never go away. You could never do real estate or mortgages over the computer. It's not happening. There's too many moving parts. There's too many variables. There's too much going on. You need somebody to orchestrate that, and you always will.
mhm.
That's why the best way to separate yourself is to just be that teacher that they need, be that they can go to. All right, let me call my mortgage guy. Right, I had it done this Saturday at 7:00. Guy texts me at 6:50 a.m. Hey, just give me a call. I called him at 6:55. We went over his loan. This was this weekend in the morning. I don't have you're not going to do that with AI. You're not going to do that with an 800 number. It's not happening.
No, they can't. They don't even understand what you're saying. Unfortunately, that's a good point you make. It would be one thing. I mean, I deal with GoDaddy here and there, and they pick up the phone, and they're basically your best friend. It sounds like you're talking to the local hardware store. That is amazing. You're not dealing with someone across the world. I'm always shocked. You can get someone and talk to them, and they are. I mean, you'll never see me give anyone credit in that world, but I give them credit. They're what you wish everyone else was.
And that's amazing. Right? Like, the fact that you can call somebody and get them on the phone and, whatever grievance or you have, and you can get it rectified, or at least it's going to attempt to be rectified, at the very least, you win that way. Those are base hits. I look for base hits,
Yeah,
when
right.
you get enough
Get
of those,
around
you
because
start
some
scoring
guys.
runs,
You're right. Well, Jason, thanks so much, man. I really appreciate what you do. With PlugIntro, we're here to gain local exposure for you and improve or create business relations for everyone involved. The local business platform is geared for everyone to get better to know each other and receive introductions and become featured as the go-to resource for their services. So we are doing a great job. Let's reconnect in the very next while to learn more about the shifting market.
Absolutely. Thanks for having me.